This is NBR.
Our market guest tonight is bullish for 2013. He's Wayne Kaufman, Chief Market Analyst at John Thomas Financial. So, Wayne, give us your bullish case. Make a case for us about why you see that the Dow and the S&P will be up by as much as 12% in 2013.
Well, I do think there's a very good chance that the major indexes, the S&P and the Dow, make new all-time highs sometime in 2013. You've been going over the housing market doing much better, but the entire construction industry, the whole building sector, is also doing a lot better. There's something called the Architects Work on the Boards Index, and that shows the contracts that the architects have been getting. That's making multi-year highs. The automobile industry is doing much better. Payrolls are better. The jobless claims are improving. And based on that, the consumer's ability to pay their debts is at the best levels that it's been since the 1980s. And that's very important, with the consumer being 70% of the economy. GDP for third quarter was 3.1%, which was a big increase over second quarter, which was only 1.3%. In addition to this, you've got a synchronized global program of asset buying by central banks around the world. You've got the Fed, and you know they always say don't fight the Fed. You've got the ECB, you've got the government in China. So if don't fight the Fed works, well, you really don't want to take on all of these central banks. And market action has been showing this, where when the year closes here, we're going to see new all-time yearly closing highs on the small cap index, on the mid cap index, and on the Dow Transportation Index. Those are yearly closing highs. The NASDAQ,
Go ahead. I want to jump in and ask you. So you're talking mostly here about equities. For investors who have money in bonds, should they be now transferring money into equities, or do you still see that it makes sense to keep some of your money in treasuries and other bonds?
It depends on the investor. If the yield is important to them as income, and they won't need to sell their bonds before maturity, then I say hang on to them. I'm not one of those people who thinks that bonds are going to take a big drop. I would be skeptical of trying to play it tactically, which means, you know, buy some bonds and then you'll look to sell them quickly. I wouldn't be doing that. But an investor who values the bond income, I wouldn't have a problem with them still being in the bond market.
Wayne, you know everybody on Wall Street and in Washington is talking about this fiscal cliff. If the negotiations carry over into January and stocks sell off, would you still be this bullish, or are you going to change your forecast?
I will still be this bullish, and I think the odds say that that's going to be a buying opportunity. I think the only thing that surprises me about this is the amount of people who are surprised that there hasn't been a quick resolution to this. These types of negotiations always go down to the wire. Plus, there's some easy fixes that they can make in January. For example, they can let all the rates go up, then they can do a quick vote to lower rates on the 98%, the lower 98%, which will leave a higher rate on the top 2%. They can do this quickly and they'll get Republican support. And my question at that time will be, for the Democrats, is that a fair share? Will they finally say, yes, this is now the fair share? Other than that, I'm just worried about policy mistakes, and the biggest ones for me would be if they let a tax increase be across the board for everybody, and in the energy area, if they really come down hard on fracking, which has been a very important asset for our country.
All right. I'm sorry we have to leave it there. It's an interesting conversation. Thank you so much, Wayne. Best wishes for the new year. Wayne Kaufman of John Thomas Financial.